Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, educational language. I'm your host at AlgoBot, and today we're exploring an expert advisor called Elder Ray Trend Pullback. This strategy is built on Dr. Alexander Elder's classic Elder Ray oscillator, and it follows a trend pullback style of trading, waiting for a healthy trend to pause, then looking to join it as it resumes. Over the next several minutes, you'll learn how the indicator works, how the entry and exit logic is coded, and how a sample trade unfolds. Remember, this is educational information only, not financial advice. Let's start with the big picture. The Elder Ray Trend Pullback Expert Advisor is a trend-following system that specializes in one particular moment, the pullback. Rather than chasing price as it breaks out to new highs or lows, this approach waits patiently for an existing trend to take a breather, then looks to join that trend as it shows signs of resuming. At the heart of the strategy sits a single exponential moving average, or EMA. What's elegant about the design is that this one average does two jobs at once. First, its slope defines the trend. If the EMA is higher now than it was a few bars ago, the strategy considers the market to be in an uptrend, and the reverse defines a downtrend. Second, that same average becomes the reference mean for the Elder Ray oscillator, which measures how far the bulls and bears are pushing price away from it. The strategy is fully symmetric, meaning it treats long and short opportunities as mirror images of one another. In an uptrend, it looks to buy dips, and in a downtrend, it looks to sell rallies. It's designed with trending instruments in mind, such as major foreign exchange pairs or metals like gold, typically on the 30-minute to 4-hour time frames, though nothing in the code is hardwired to a single market or time frame. In terms of who this style might suit, it leans toward traders who prefer a patient, rules-based approach with clearly defined risk on every position. Every trade carries a volatility-based stop and a fixed reward-to-risk target from the moment it opens. As always, this is educational content, and trading carries real risk, including the risk of loss. Now let's walk through exactly how the strategy makes its decisions, step by step. Everything happens once per newly closed bar, so the EA is not reacting to every tick. It waits for a bar to finish before it evaluates anything. The first step is the trend gate. The strategy compares the EMA's current value to its value a set number of bars ago, controlled by the slope lookback parameter. If the average is higher now, the market is judged to be in an uptrend. If it's lower, that's a downtrend. If the average is flat, no trade is considered at all. The second step is the Elder Ray reading. Bull power is defined as the bar's high minus the EMA, which is how far buyers pushed price above the mean. Bear power is the bar's low minus the EMA, which is how far sellers pushed price below it. In a healthy uptrend, bear power normally sits below zero because each bar's low dips under the average. The key insight is what happens on a pullback. When bear power is still negative but has ticked back upward compared to the previous bar, it suggests the sellers are losing their grip and the uptrend may be about to resume. So for a long setup, conditions must all line up. The market must be in an uptrend. Bear power must be negative but higher than it was on the prior bar. The depth of that dip must be at least a fraction of ATR, set by the minimum dip parameter, so the strategy ignores trivial noise. And the just closed bar must close bullish above its open. When all four agree, the EA signals a buy. The short side is the exact mirror. In a downtrend, bull power must be positive but turning down versus the prior bar. The poke above the mean must be at least that same fraction of ATR, and the bar must close bearish. When those align, the EA signals a sell. Risk is defined immediately. The stop loss is placed a multiple of AT or beyond the entry, set by the AT or stop multiplier parameter, and it is never allowed inside the broker's minimum stop distance. The take profit is placed at the reward ratio multiplied by that stop distance, giving a fixed reward to risk on every trade. Only one position runs per magic number at a time, and the stop and target handle the exit. Let's look at the actual MQL5 code the expert advisor runs, styled here as you'd see it in MetaEditor. At the top are the input parameters, the knobs you can adjust. EmaPeriod, defaulting to 13, sets the moving average that serves as both trend baseline and oscillator mean. Slope lookback, defaulting to 3, is how many bars back the slope is measured. AtrPeriod feeds the volatility stop. The AtrSlMult stop multiplier at 2.0 scales that stop, and reward ratio at 1.8 sets the take profit relative to it. Minimum dip filters out shallow, noisy pullbacks, and lots is the base position size before equity scaling. Below the inputs is the long block. Read the condition. The market must be in an uptrend. Bear power must be below zero but greater than the previous bar's bear power. The negative of bear power must meet the minimum dip, and the current close must be above the current open. When that's all true, the code computes the entry at the ask, a stop a distance below it, and a take profit at the reward ratio above, then calls fire with an order type of buy. The short block is the mirror image. In a downtrend, bull power must be positive but below the prior bar's bull power. The poke must meet the minimum dip, and the bar must close below its open. It then sets the stop above the entry and the take profit below, and calls fire with an order type of sell. Inside fire, the sized volume is sent to market through trade.buy or trade.sell. That's the whole engine, kept deliberately compact and readable. Let's bring the whole strategy to life on a chart. On screen, you can see a candlestick sequence with the exponential moving average drawn through the price as a smooth line. That's our trend baseline and our reference mean. Below the price sits the Elder Ray subpanel, showing bull power in green and bear power in red, oscillating around the zero line. Remember, the zero line represents the moving average itself, so when a reading is above zero, price is trading above the mean, and below zero means price is under it. Look at the opening candles on the left. Price is stepping higher, and the EMA line is sloping upward beneath it. This satisfies the strategy's first requirement. The trend gate reads an uptrend. In the subpanel, bull power sits comfortably in positive territory while bear power hovers near or just below zero. The market is climbing, and the strategy is simply watching, waiting for a pause. That pause arrives at the fourth candle. Price pulls back, printing a bearish bar whose low dips well beneath the EMA. In the subpanel, you can see bear power plunge deeper into negative territory. This is the give back the strategy has been waiting for. But one dip alone is not enough. The very next bar is where the conditions align. Notice how price closes back above its open, forming a bullish candle, and bear power ticks upward from its low point while still sitting below zero. The sellers pushed, but they couldn't hold, and the dip was deep enough to clear the minimum dip filter. All four long conditions now agree, and the buy entry marker appears on the chart. From here, the trade is fully defined the moment it opens. The stop loss rests a multiple of AT below the entry, just beneath the recent swing low, while the take profit target sits above at 1.8 times that stop distance. Watch what happens next. Price resumes its climb, candle after candle pushing higher as the uptrend reasserts itself. Bull power expands in the subpanel, confirming the buyers are back in control. A few bars later, price reaches the take profit target, and the long trade closes in profit for this illustration. Now the character of the market changes. Near the top, price stalls and prints a couple of bearish candles, and the EMA line begins to roll over and slope downward. The trend gate now reads a downtrend, so the strategy flips its attention to the mirror image setup, selling a rally rather than buying a dip. Watch the rally candle push upward against the falling average. Its high pokes above the EMA, and in the subpanel bull power jumps back into positive territory as bulls make one last attempt. The next candle is the one that matters. Price closes bearish, back below its open, and bull power turns down from its peak while remaining above zero. That's the fading strength signal the short side needs, and the poke above the mean was tall enough to clear the same minimum dip filter. The sell entry marker now appears. Just like the long, the risk is defined instantly. The stop loss sits a multiple of AT above the entry, just over the little rally high, and the take profit target is placed below at the same 1.8 reward to risk. From there, price rolls over and works its way down, bar by bar, as the downtrend resumes. Bear power stretches lower in the subpanel, and eventually price reaches the take profit target below, closing the short trade for this illustration. Notice the symmetry throughout. Whether long or short, the recipe is identical. An established trend, a pullback against it, a fading of the counter move measured by Elder Ray, a confirming candle close, and then a stop and target defined in the same breath as the entry. That disciplined, repeatable structure is the whole idea behind the Elder Ray Trend Pullback approach. That brings us to the end of our look at the Elder Ray Trend Pullback Expert Advisor. Today we covered how a single EMA defines both the trend and the oscillator mean, how bull power and bear power identify a fading pullback, how the long and short entry conditions mirror each other, and how the ATR stop and fixed reward to risk target manage every trade. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do occur. If you found this breakdown helpful, please like the video, leave a comment with any strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy walkthroughs. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.